listening to the Decisive podcast, insights and analysis to empower confident decision-making.
Corporations, organizations, and governments are processing the tariff announcements of April 2nd, calculating new tariff rates, assessing exposures, and determining how to pivot effectively. The situation is very fluid. Affected countries and companies are offering a wide range of responses, from accommodation to reciprocity. Based on the current state of play, underlying structural factors, and the motivations of key actors, in today's discussion, we will identify where the impacts will be felt more immediately and acutely, what knock-on effects we should be aware of, and finally, what indicators to watch to understand the direction of travel beyond the immediate horizon. To discuss this, we are joined by the following experts from S&P Global Market Intelligence. Ken Wattret, Vice President, Global Economics. Aries Poon, Head of APAC Insights and Analysis. Eric Oak, Senior Supply Chain Analyst. And Thomas McCartin, Senior Principal Economist, Pricing and Purchasing. Eric, can you set the scene for us first? Can we talk about some of the basic issues at play here? What is going on? What happened last week, and what does it look like today?
Great. Thanks, Kristen. I think it's important to just go through very quickly at the beginning, just a quick terminology overview, just to make sure everybody's on the exact same page. I think tariffs are taxes on either the export or import of goods issued by countries. Tariffs have a variety of use cases, both on the political and the economic side. One of the most classic use cases for tariffs is to protect the domestic industry from competition from overseas exports. Tariffs are very good at what they are meant to do. And what they are meant to do is increase the price of the goods, either on the export or the import side. Obviously, there's a lot of discussion about the effectiveness of that when it comes to other objectives. But again, for this discussion, let's just remember that tariffs are very simple. Price increase on, let's just say, imports for now, because import tariffs are the ones that we're really talking about. So again, when you think about these tariffs, what these tariffs are again, a levy on imported goods, usually based on either the product or the country of origin. So both of those things matter. The country of origin oftentimes can be a tricky thing to answer, especially with products in the global supply chain that have multiple inputs, potentially products or components from multiple different countries across the globe. But generally what we see is that customs departments look for a substantial transformation on that last step to determine the country of origin. But generally what we're going to see is, as these tariffs are applied, an increase in the price of goods that are imported from these countries or products. What we've seen currently and what we're dealing with today, and this could be out of date, as I'm speaking, but we've seen a few main tranches of tariffs come into play. So the first one to kind of keep in mind is the Section 301 duties on China that were applied back in 2019. Those are still in effect, and actually they were expanded by the previous administration last year. So those duties, if you are importing from China, would still be in effect. Again, most companies have understood the impacts and worked those into their calculations at this point. We also seen a removal of the broad-based exceptions for a lot of countries on the 232 reviews on steel and aluminum. So both of those, again, were put into place back in the previous Trump administration back in 2018. Over the years, various exceptions were added based on individual negotiations and work that both administrations previously had done. Those exceptions have been removed, and what the government is now looking to do is put duties on those, both steel and aluminum products, based on the non-U.S. content of those items. So that's going to be another trend that we'll talk about a little bit, is that tariffs, while being an additional cost of the goods themselves, oftentimes how these are implemented will add an additional kind of administrative overhead to your imports. You have to understand different nuances of products that you might not have had to understand previously. This is especially apparent in things like the automotive sector, which has also received a new 232 review last week, putting duties for national security reasons on imports of automobiles and parts. The final kind of tranche of these duties is the IEEPA measures, is what we call them kind of as a whole. So these are national emergency declarations that have put duties on China, Canada, Mexico, and now the entire world. So there's really, I think there's technically 4 different national emergencies there. And then we've got the reciprocal duties with its own notice. And that is, again, 10% on everybody across the globe, with very specific additional tariffs for countries that have larger trade deficits with the United States. And those were applied last night, I believe, or today. Those went into effect. So a situation in progress. So we really don't know the outcome or what those could be.
Thank you, Eric, for that overview. Again, a very fluid and dynamic situation as you've outlined for us there. So I wanted to ask you, what about existing trade agreements like USMCA, Eric? What is happening there?
So what we've seen with a lot of these duties, and again, it's hard to be specific, but what we've seen is that USMCA specifically, so Canada and Mexico, have gotten carve-outs for some of these duties, be it, autos, et cetera, that really tries to put a little bit less strain on the cross-border supply chains, the land cross-border supply chains that the U.S. has for those companies. Especially autos is very important, where parts can move across the border multiple times before it's being assembled into a final automobile. What we've seen, though, is that even with, USMCA exemptions, et cetera, the executive orders are looking to do is still put the tariffs in place on the non-U.S. content of goods. And so what we've seen is that the USMCA carve-outs have been essentially temporary stays of the duties while the Customs and Border Patrol are able to put in place systems to put a levy on the non-U.S. content of some of those goods. So unfortunately, USMCA countries will still be impacted. Really, any country with an existing trade agreement is going to be impacted by these duties. The one thing you want to look for when reviewing some of these new orders, especially executive orders, is language around, this is in addition to all other applicable duties, fees, levies, et cetera, that may be issued on this product. So, and almost all of these notices are in addition. Almost all of these tariffs are stacking. There is an exception for the reciprocal IEEPA duties and the 232 duties, where products covered under those 232 notices are not going to be subject to the reciprocal tariffs. So that is one exception there that kind of bucks the trend that we normally see with duties and tariffs as we go. But again, keep in mind that kind of the worst case scenario is absolutely a stacking, everything on top of each other duty for certain products.
Eric, how are we thinking about this from a supply chain perspective? What impact is this likely to have on supply chains and global trade?
So I think the overarching thing to keep in mind is that regardless of the specific impacts, that protectionism is going to increase costs in general. So costs will go up, especially if you consider kind of a status quo where you assume that the demand for goods and the supply of goods is going to be relatively stable, which could be completely wrong. Again, that's not something that we're trying to predict here. But again, tariffs will increase costs in a kind of a static simulation. So what you're thinking about from a supply chain perspective is how you can work with your suppliers, how you can adapt and change your supply chain to mitigate some of those costs. We've seen a lot of different strategies that companies have been using over, probably over the last decade to try to mitigate some of these tariff costs, whether if you move their sourcing to countries with either lower tariffs or lower costs of goods production. We've seen companies pass through prices. That's always an option, although for some companies, it may not be a viable option. We've also seen companies start to do things like stockpiling or short-term suspensions in trade to try to handle these duties. Not all these strategies are necessarily effective by themselves in the long term. What we do see is that companies will use a variety of these strategies to try to mitigate the impact of new duties on their financials in the short term. So in the long term, again, companies need to adapt. That's really the only option, is to adapt their supply chains, adapt what they're selling. And unfortunately, it does mean, again, back to the kind of the gist of this all, it's either extra direct costs or extra regulatory costs. There's really no way around it.
All right. Thank you, Eric. Let's pivot to Aries now and zero in on the Asia Pacific region. Lots to talk about there. What are we seeing from key APAC trading partners, Aries?
Thanks, Kristen. I think let's begin with mainland China, which is all on the headlines over the past week. And what we can see is April 2nd is more like a watershed moment in terms of China's approach or response to the US. Before April 2nd, it was more targeted, it was more measured. But after April 2nd, the response is broader. So we are monitoring that very closely for now. So Japan and South Korea, they are major U.S. allies in the region in terms of security. So the approach would be quite different, because when we see this negotiation here, if it fails or if they are going to negotiation, then they tend to sort of go into the space of countermeasures. But if they are not going to go down that path and they're trying to, accommodate, what the U.S. has been requesting, then they're going to the other direction, which is policy rationalization or tariffs, rationalization. And this is what we are seeing from Japan and South Korea. One of the consideration of accommodating U.S. requests would be, increasing energy imports, actually LNG from the U.S. And also they might be increase their investment in the U.S. And we see all these technology companies, semiconductor companies, even car makers, they are making, plans, or they have already beginning to build factories in the U.S. So because of the security concern, Japan and South Korea, they are not, the bilateral relations between U.S. and Japan and South Korea will be much less confrontational. But one thing about South Korea is the negotiation process is further complicated by the government transition, because former President Yoon Suk-yeol was just formally impeached, and then the country is going into an election in June. So that will complicate some of the policy continuity on the South Korea side. But probably either, regardless of the outcome, I think whoever wins the presidency will likely have a very high incentive to maintain a sustainable and the least possible tariffs relationship with the U.S.
Thanks, Aries. And what would be the knock on impacts to the wider APAC region, such as ASEAN countries and India?
I think there are two routes for the transmission channel. One is the possibly weaker demand from China and globally, and the other one is possibly weaker flow of FDI, foreign direct investment, into these countries. So let's focus on the China plus one first, because for countries like Vietnam, Malaysia, Indonesia, all these so-called China plus one FDI, meaning that the Chinese firms or foreign firms, they are setting up alternative or additional factories outside of China, and they are going after the lower labor cost and, in places where the labor skills are matching, and there might be some other, regulations or infrastructure that are more pro-business. So those FDR has been a major source for economic growth for many of the ASEAN countries, because it also brings in jobs, and then, it will increase the consumption power and the wages of those countries. So I think what happens right now is different from Trump 1.0. Now, Trump is not just imposing tariffs on China, but also imposing on these China plus one countries, meaning that the incentive for these companies to further relocate or to make in these destination as offshore factories for their investors or whatever, it is not going to be as lucrative, or is not actually as viable as before because of the added tariffs, because Vietnam, for example, it has a very high tariffs. So I think that will change. However, FDI will still flow into these countries, maybe more slowly, because the factories in China or the companies that I mentioned before, they might not be exporting that much to the US because of the tariffs, but they're very incentivized to expand to other emerging markets or Europe. So even though it's not possible to fully fill the gap, but there is an incentive for market diversification for these companies. And therefore, the China plus one FDI will be slowing down, but it's not going to go away. And that means for these countries, they have to rethink how reliant they want to be on FDI, or if they decide that they want to do this, they need to really remove more red tapes and sign more agreements, and maybe there have been some measures in place to control labor costs and make sure that the labor pool is in terms of skill, they are capable of attracting these, because the cost of staying is higher now for these countries. And the other thing is, if FDI grows more slowly, what happens is it might have a knock-on impact for the private investment and consumption locally, because oftentimes this smaller SME locally, they might be further outsourcing jobs from these China plus one factories. So if they are reducing their presence, then for these SME, they might be seeing reducing business as well. So there will be the whole cycle of reducing jobs and reducing domestic demand, reducing weaker GDP growth. And it will be more consequential if the countries have weak fiscal position, for example, Bangladesh, Sri Lanka, Pakistan, and so there will be a knock-on impact along those lines.
All right, thanks, Aries. And then Just really quickly to wrap up our APAC segment, which countries in emerging Asia would be most impacted, Aries, and how are they likely to respond?
So based on pre-negotiation, because almost all ASEAN countries are trying to negotiate, but pre-negotiation, Vietnam is the most exposed because our calculation shows that around 9.9% of Vietnam's GDP would be exposed to the reciprocal tariffs and related impacts if the rate stays at the current level. And after Vietnam, there will be Cambodia, Taiwan, Thailand, and Malaysia. And the impact on the GDP ranges from 2.5% for Malaysia to 5.6% for Cambodia. And for India, the estimate is only 0.5% GDP being exposed, and mainly because it has preemptively done a lot. For example, it has already pursuing some of the manufacturing related tariff rationalization, and also it has prepared to increase defense purchase and energy from the US. However, India is very likely to be resistant to offer concessions in agriculture. In fact, among all the countries, Vietnam has gone the furthest in its response in order to make sure that the negotiation can yield to not countermeasures, but the other side, which is having rate reduced by exchanging concessions. It's already seeking a 45-day postponement and is proposing a mutual zero tariff with the US on the bilateral trade. And Vietnam has also preemptively reduced tariffs of some of the industrial goods. And one thing I want to bring up is we are seeing increased effort for ASEAN countries to sign up more FTAs. I think because, they need to make sure they have plan B or plan C in place. So what we can see is, for example, Indonesia, Malaysia, the Philippines, and Thailand, they're all right now at various stages of negotiating FTAs with the EU. And Singapore and Vietnam, they already have the FTAs in the EU. And also the ASEAN will likely to aim at to expedite the ongoing talks to upgrade the ASEAN Trade in Goods Agreement, ATIGA, to facilitate intra-ASEAN trade. And also lately, Malaysia's Prime Minister Anwar who's chairing ASEAN in 2025, they have been working alongside with Brunei, Indonesia, Philippines, Singapore, and Vietnam to come up with a coordinated joint response. So we do see this is what we are talking about, the trade regionalization of APEC, which will be something down the road that might be happening. Not soon, because everyone's still figuring out tariffs for now, and we're still adjusting. But probably down the road, say maybe after a year and a half, if the direction goes this way, we might be starting to see there will be some noticeable shift in the trade and investment patterns among Asian countries because of the US tariff policy. So I think that is what we would expect, beyond still 1 year outlook.
Thank you, Aries. Let's pivot now to Ken. Let's talk about Europe first. Can you give us the picture for Europe, Ken? Before this announcement, Germany was one of our bright spots in the EU, but now what?
Hi, Kristen. Hi, everybody. Yeah, Germany was one of the bright spots because they announced a sea change in fiscal policy. That contributed to a more positive assessment of our economic outlook for Western Europe as of our March update. Now, of course, we're having to deal with another adverse shock. So we're in the process of reviewing all our forecasts. Currently, we'll be revising down our growth projections across Europe to reflect these latest developments. Now, it might be helpful to start by clarifying our assumption on how the EU and the UK, for example, are responding to reciprocal tariffs from the US. In brief, they're taking a pretty cautious approach. They're looking to negotiate if they can. That's because economic conditions are already fragile and they really want to avoid an escalation. So possible routes forward in that respect include maybe some exemptions for EU exports to the US in exchange for reduced tariffs on US imports into the EU, a commitment to import more US defense equipment as part of the wider shift towards increased defense expenditure, and also more purchases of agricultural and energy products, maybe also a relaxation of regulatory requirements that affect US exporters into Europe. So there are a few channels that can be used to try and mitigate this trade shock. The second thing to think about when we're talking about, how bad the outcomes might be is to think about direct effects on economic performance and indirect effects. So the direct effects we can calibrate. We just heard for APAC, some countries have much bigger export shares in GDP and much bigger direct trade exposure with the US. We can incorporate that into our forecast adjustments. And then we have to think about the indirect effects, and they're a bit more difficult to quantify. We're thinking about impacts on demand in other export markets for European countries. We're talking about potential reductions in the propensity of consumers to spend or businesses to invest, given the high levels of uncertainty currently. We're talking about movements in exchange rates impacting on competitiveness, and in some countries, negative wealth effects from declining equity prices. So there are a lot of different things to consider. We also have this issue of crosswinds. So as we mentioned at the start, we had this big shift in German fiscal policy. We became a little more optimistic about growth prospects in Germany specifically, but also some spillovers to the rest of Europe from 2026 onwards. Now we're having to factor in, a more immediate shock. So, the bottom line for our growth forecasts is that they were already pretty low for, many parts of Western Europe. For the EU as a whole, prior to this, we're now revising down. And for some countries in the region, unfortunately, they're going to be materially impacted. You have big countries like Germany, which are very export dependent. They're going to be hit by, obviously, the impact of tariffs on their exports into the US, but also weaker demand conditions globally. And on top of that, they're a big auto exporter, and the tariffs on, that sector are particularly high. So it's not a uniform effect across the region. Some are going to be more affected than others, some of the bigger ones. And then there are internal, supply chain linkages within Europe. So if Germany is very adversely affected through the auto sector and through exports more generally, then, the countries that they trade with, for parts and so on in Europe will also be impacted. And that means, many in emerging Europe. But the bottom line is we were already pretty pessimistic, and now we're revising down our forecasts even further.
All right. Thanks for that insight, Ken, into how you approach the forecast. What does this mean for US growth? Are we headed for a recession there, Ken?
Yeah, I mean, that's the big question at the moment. Are we headed for a recession? Obviously, both in the US and elsewhere. I think it might be helpful, first of all, to to be more clear about how we define a recession, particularly in the US instance. There's a difference between a short-lived technical recession, which is, defined as consecutive quarter-over-quarter contractions in real GDP, and a period of broader, more persistent output contraction leading to large-scale job losses, and then a kind of feedback effect, a vicious cycle, and more widespread economic weakness. Now, we've just updated our US forecasts, and we've cut our annual real GDP growth projections for this year and next substantially by about 0.5 percentage point in both years. So they're now sitting at around 1% for 2025 and 2026. Now, that doesn't sound too bad, but annual rates can be a bit misleading because of carryover effects from one year to the next. If we look at the quarter-over-quarter forecasts, we're not quite predicting a technical recession in the US this year, but it's a really close call. The growth profile looks pretty soft through most of the year. We already have quite a lot of data for the first quarter, and our tracking estimate is suggesting minimal real GDP growth in that quarter. If business confidence weakens, and it's pretty likely that it will, but if it weakens more than we've assumed in the subsequent quarters, impacting on investment and employment, then technical recession becomes the base case. To meet the more formal definition of a recession, the bar's higher because that definition looks at the depth, the duration, and the diversity of output losses. So that's a bit more difficult to get to. And as with our forecast for Europe, what we assume about tariffs and countermeasures, is pivotal. Long story short, we've assumed in this forecast that the reciprocal tariffs persist, with some carve-outs here and there along the lines of what Eric was talking about at the beginning. If that's too pessimistic, and the economic disruption, financial market volatility that we're seeing recently leads the US administration to row back a bit, then recession risk diminishes. Alternatively, if there's a ratcheting up and there are major spillovers to various, transmission channels, confidence effects, financial markets, and so on, then a broader based, deeper, longer lasting recession would become the base case. For the moment, we have kind of 50-50 chance, we think, of a technical recession in the period ahead, subject to the assumptions we've made about trade policy.
Thanks for that, Ken. Now, what indicators are you looking at and what should we be watching for with regards to US inflation expectations?
Well, yeah, I mean, as you can imagine, we're looking at every indicator which is available because this is really going to be pivotal, to how the central bank can respond to what is a pretty difficult set of circumstances to deal with for monetary policy. Now, we've got indicators that take a bit of time to materialize, and then we've got indicators that are more timely. We prefer to look at the more timely ones at the moment to see if there are any signs, on the growth side that the reciprocal tariffs and related market turbulence are materially impacting on behavior. When we include our purchasing managers indices, in that group, and they too, the PMIs give us a steer on what's happening to prices. There are also lots of other measures that are produced in a timely fashion that we're, keeping a close eye on, in particular measures of policy related uncertainty. They can be quite significant for business investment, and they can be a key swing factor in determining whether, recessions are averted, to refer to what we were just talking about. Trade policy uncertainty in the US, I mean, that's been really remarkable recently. We've seen those indicators soar to unprecedented levels. And worryingly, that's even before the announcements of reciprocal tariffs and the carnage in financial markets, that we've seen over the last few days. With regard to inflation, we get consumer price inflation prints in the US and most countries pretty quickly. And we should be able to gauge the impact of some of these, changes in trade policy relatively swiftly. For inflation expectations, there are two kind of broad categories of measures that, we keep an eye on. One are market-based measures, break-even inflation rate. They've been relatively stable so far, which is a relief. And then there are some surveys, surveys of households' expectations, and they haven't been as encouraging. One of the surveys, the University of Michigan Consumer Price Expectation Survey for the long run, beyond 5 years, that's really spiked in the latest print, an increase the likes of which we haven't seen since the 1990s. And again, that was before the reciprocal tariff announcements. And that's a bit worrying. And, to explain the reason why we'd focus on inflation expectations is because in theory, tariffs represent a one-off change in the price level. They don't imply persistent higher inflation. But in practice, if inflation expectations become unmoored, then the inflationary effects can persist. One route through that would be, pressure for higher wages to compensate for the increase in prices, leading to a broader increase in costs and an underlying inflation. And that's something that the Fed is going to be hugely sensitive to. So if we continue to see more evidence of inflation expectations, shifting upwards, then that will give the Fed less room to respond to the weakness in economic activity, which is, beginning to materialize. They'll have to be focused more on inflationary risks, and that in turn would increase the probability of recessions.
Is there anything more you can tell us about the Fed's potential response there? What have they been signaling, Ken?
Yeah, I mean, they've been signaling basically, what we've been signaling in the direction of travel of our forecast. Inflation forecasts are being revised up and growth forecasts are being revised down. Now, the Fed has a dual mandate, so it has to, balance delivery of price stability with labor market conditions, and that complicates the assessment of what the Fed will do. Now, financial markets have, made a decision. Futures markets are currently pricing in, about 100 basis points of Fed rate cuts this year. That's because the view is, look, markets are in turmoil. The Fed's sensitive to that. Economic prospects are deteriorating, and the Fed's sensitive to that. So, we should expect a stream of rate cuts, and that should happen quite soon. We're a little skeptical about that, for the reasons partly explained. Inflation's expected to pick up. We're now thinking of a peak for core PCE inflation, which is the Fed's target measure later this year, of about 4%. That's double the target Can the Fed really be slashing interest rates in that environment? That's questionable. So we're thinking it's going to be, for the moment, the Fed worried about inflation, signaling that probably there is some scope for easing, but that easing is going to come later. So we only have an initial rate cut in our base case in the final quarter of this year, but we then have a stream of rate cuts in 2026 as inflationary concerns, diminish. The wild card in all this is if, financial market turbulence really starts to get out of hand, and then the feedback effect of that back into the real economy looks like, producing potentially, severe recession more quickly, then the Fed will think inflation in the future will be lower and they'll start to cut rates. But for the moment, that's not our base case.
All right, thanks, Ken. And in the interest of time, I'll just pose one more for you before we pivot to Tommy. What does all of this mean for global growth, Ken? Can you zoom out and give us that picture?
Yeah, sure. I mean, I think as everybody's probably concluded from what's been said so far, it's not good. So, it's a question of potentially how big downward revisions to global growth are, assuming this shift in US trade policy, is not going to be, dramatically reversed in the immediate future. So we've been doing some preliminary calculations based on, most of the large economies that we forecast. And, we're proposing to revise down our annual global real GDP growth projections for this year and for next year by around half a percentage point. That would imply growth rates of 2% annually, broadly speaking, for both years. Now, you might say, well, that's not too bad. 2% global growth sounds quite decent, but they would be the weakest global growth rates we've seen outside of the COVID-19 shock since the global financial crisis back in 2008, 2009. So 2% global growth is normally the kind of outcomes you see in, a pretty severe shock. As already mentioned, the same kind of caveats apply surrounding these base case forecasts. Uncertainty is very high, particularly related to trade policy. If our assumptions about tariffs and countermeasures are incorrect, the outlook could be, significantly different one way or the other. But it looks increasingly to us going forward as if the risk distribution is tilted towards weaker rather than stronger.
Thank you, Ken. Let's zero in now on which industries are most likely to be impacted. Tommy, what can you tell us about that?
Thanks, Kristen. In the US, we've already seen the Section 232 tariffs on steel, aluminum, and fabricated metals took place in March. So those are already in place at 25%. We had automobiles just in the past week face 232 tariffs, and then already set for early May is for auto parts. And then what's been signaled is potential Section 232 action on copper, and pricing has already shown up in that market, on lumber, semiconductors, and then in the pharmaceuticals market. Those all have potential 232 action. But at the general country level tariffs, looking at the categories that are heavily import dependent in the US, it's non-electrical machinery, electrical machinery, which faces long lead times and shortages in some pretty key categories already. And then consumer electronics is a major one. Toys as well. Won't focus on that one, but from consumer electronics, your laptops, smartphones in the US market, majority of those come from China. These are goods that in 2018, 2019, they were left unimpacted by the Section 301 tariffs that the US put on China. But already we've seen the 10% increases and then the reciprocal tariffs that were announced last week and implemented today. Those are all impacting laptops and smartphones from now on. So those categories will get the single biggest increases. It's really your electronics.
Thanks, Tommy. And what impact are we seeing on US manufacturing?
The clear thing is costs are up. So the cost of manufacturing in the US is already up significantly. There are a lot of things made with steel, with aluminum. There are machinery that include fabricated metal products as components. And for about a month now, all of those have faced higher pricing. In addition, I think the key thing here, we're having a global focused conversation. This is higher costs in the US. It's not necessarily higher costs in any other regions. And in some cases, it's more flat to slight on the margin declines in manufacturing costs in other regions. So, it is a lot of doom and gloom in the conversation from a sourcing perspective in the US, much higher costs. but there are buying opportunities. There is better leverage for sourcing in other regions.
All right. Thanks, Tommy. And which specific sectors do you believe are most vulnerable to the tariffs? And what are the underlying reasons for that susceptibility, Tommy?
Yeah, so something we saw in 2018 with the steel and aluminum Section 232 tariffs is that increased protection for steel and aluminum producers in the US. But for any manufacturers that use steel and aluminum as inputs, they faced higher input costs, but they still faced import competition. Now we have fabricated metals included under the 232 tariffs, but then anything downstream of steel, aluminum, and fabrications, they face higher input costs, but less protection. So still continued import competition. So those sectors that get higher input costs, but aren't as readily able to pass on those costs to end pricing, that's where you find a key holdup. And then any US based manufacturer that has quite a lot of components coming from China, where we've seen now, as of today, 104% in new tariffs this year, those supply chains become pretty untenable. It's tough to pass along those costs.
All right, thank you. And that's all the time we have for today. We've given you a lot to think about, and we're committed to continuing the conversation. Thank you to Aries, Ken, Eric, and Tommy for sharing their insights with us. And thanks to you for engaging with us today.
Thank you for listening to the Decisive podcast from S&P Global. Please subscribe and join us for next week's episode. Until then, stay curious and stay informed.